Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, May 20th, 2026. What I'll do in this video, I'll try to keep it in this order. Quick update on the equity markets, the video that's posting earnings tonight, and then just some of the other things I'm watching. Some I've gotten out to you recently, Treasuries, crude oil, a couple individual trade ideas, and kind of that ongoing theme of indirect hedges. For example, I got out a couple of, well, one was a tech stock, one had nothing to do with tech, Beyond Meat, and I consider those both indirect hedges as well to any index shorts, and I'll tell you why. So let me just start out with the markets here, and I'll make a reference for some of you. Well, I'm dating myself, but for those of you old enough to remember, there was a movie back in the 80s called Less Than Zero. It had Robert Downey Jr., James Spader, Jamie Gertz, I think was her name. Anyways, if you saw the movie, you know what I'm talking about. But the theme of that is I put literally a less than zero weighting into today's rally. Why did I do that? By oversight, I forgot that every year I forget NVDA is an outlier. You have peak earnings season. I talk about that at the end of the middle to the end of April. You have all of the what I call the Mag 8. Everyone has a different number. Mag 7 used to be FANG, but the Mag 8, or really if you want to look at the top 10, and those are the 10 largest weighted components of the NASDAQ 100, which are also the top weighted components of the S&P 500. But when you get to the NASDAQ 100, which is really just it's a concentrated view into the stock market, because those are the companies that, again, there's nothing that comes close to them. With NVIDIA with a $5.4 trillion market cap, you go down the line, these mega trillion-dollar companies and everything else, you're barely around the corner. I think I'm looking at it right now in the NASDAQ 100 here. You can see over here to the right here. You have to add up Alphabet Class A shares at 4.8 trillion with the Class B, and that gives you closer to the 5 plus. So those guys are the 5T club. Apple 4.4 trillion. See, so they're all big tech. And then you happen to Microsoft just gets in there barely, but everything else, they're big companies, don't get me wrong, but collectively, and I do this every so often, you add them up, and the top 8 alone, Mag 8 here, let me go back to where it was, just get off my watch list. Those top 8 stocks back at the end of the year made up about 45% of the total returns of this 100 stock index. To me, that's just, again, it's phenomenal. It's math. Hey, it's great if that's what you own in your 401k, IRA long term, but it's also great to trade either way. When the when the spigot reverses, the tide starts going out. These stocks will also take the market down with it. So, bottom line, where I'm going with that long-winded rant is we broke down. We had what I believe to be very significant sell signals on Friday, as I talked about. Been waiting forever and a day to see that trend line off the March 30th lows go. And it wasn't just the NASDAQ 100. I look at those Mag 8 stocks. Collectively, the majority have broken, just waiting for Alphabet to join the fray. I'm sorry, Alphabet did break down, but I needed to take out that 384.50 right there. Some looking a little better than others. But again, the index itself has broken. And I look at other things, by the way, it's not just the NASDAQ. I look at the S&P. The Dow, to me, is a useless, antiquated index. For the life of me, I cannot understand why it's even talked about on Bloomberg and especially CNBC, quoting it all the time. It's a price-weighted index. Look that up if you don't know what that means. So it's completely ridiculous that if a company doesn't split and they take their share price up to $800 or whatever, and they're in the index that has a 10-time weighting than an $80 stock, which might have a market cap twice as big. It's just insane. Plus, it's 30 stocks. How representative of the economy can 30 individual companies be? So, the S&P, you can look at the global Dow, which also broke down recently, back testing. So again, just to reiterate and drive it home, this is just a little bounce here. Yesterday, when I put out those 5-minute bounce targets for you at resistance, again, it slipped my mind until after the market closed. I started looking at my news feed. Oh yeah, NVIDIA is reporting, because again, they're the one outlier. For whatever reason, they don't cluster together in that week that all the other 7 of the Mag 8 components report. Most of them on the same week, within a 2-week window. All right, so that's it. So we bounced back there. And the bottom line is, this was a technical catalyst. We hit T4. Told you yesterday I went long for the bounce because that's with the final short-term target. This was a very short-term trade based on a 5-minute chart, so you only had 4 targets. But I meant what I said, once we got down here, it would have longer-term implications because we would have broken the trend lines on the daily chart, which we have. Nothing goes straight down forever. We broke down. It was follow through. And today is a reflexive bounce. Hopium is one of the most powerful drugs in the world, certainly in the investment world, stock market. So, and look, NVIDIA is going to blow the cover off the ball. They always do. All these big mega tech companies are earnings juggernauts, and so it's nothing to do with do they beat the numbers or do they hit their numbers. Again, it's the market's reaction. It's any guidance they say. And I always say this, if you're new to the site, I repeat it often. There are 3 components to an earnings report. Here, let's just jump to NVIDIA. Look at the chart. So NVIDIA, first of all, is on a sell signal. It broke down from this bearish rising wedge, started going down, and it's still just like QQQ, SOXX, and XSD, which let me just go to before I forget. Those guys are still clearly on the breakdown modes, clearly below those sell signals. Doesn't guarantee that they have to play out for much more downside. It just tells you that's still my very, very much my thought. Nothing goes down forever. We have Pavlov's dogs have been buying dips for a very long time now. So this is just a reflexive dip buying day. And again, it's right in front of NVIDIA earnings. It's like take a Fed meeting and add in Apple earnings and all that all together. That's a potential big market moving event. And I'm going to say this, and I often do, it can go either way. So where I'm talking, as I usually do, I look at a chart going into earnings. If the technical posture, not the trend, that's where I differ from most people. 99.9% of people look at this chart and say, that's nothing but bullish. The stock is just off all-time highs. That's a bullish chart. It's a bullish trend. It's in a bullish uptrend, but it's bearish technical posture because it just broke down and triggered a sell signal. Therefore, from my experience, when I analyze a chart and companies going into earnings, if I look at the chart and I don't have a strong opinion either way, it's a complete crapshoot. I'd rather go to Vegas and pull the one-armed bandit or play the craps table or blackjack or whatever because the odds, I have no idea where the stock's going to go. If a chart is clearly bullish or bearish, more often than not, which is far from always, but more often than not, that's the direction the stock's going to go. So when I look at all the way out to the weekly time frame, big negative divergences. I showed you the daily. This is my 60-minute chart. We just put in that divergent high right here. Let me change my color tool. Divergent high 1, we had a nice 10% correction. Divergent high 2, the same divergence. This is not a reset of divergence. This divergence that was in place there has grown even larger. That's the same divergence you saw in my daily chart a minute ago. Then we had the sell signal. That's the same bearish rising wedge. Broke down, backtest. Now look, I will say this. The number one thing that can foil a nice, clean, bullish or bearish chart pattern following a breakout, in other words, the projection on this wedge, you take the widest part of the wedge, which is right here, add that to where the wedge breaks down. I'm just ballparking it. The way I do it accurate, if I'm trying to get a measured target, I take a trend line. I put it there and measure the widest part of the wedge. Then I take it to the point at which the wedge broke down. I haven't done that before. That T1 I gave you, I already shared this chart with you, was done well before it broke down. It never fails to amaze me. I always put my price levels first, my support, my price targets. Then when I add a measured target, it very often aligns with my the price targets that I first came up with by analyzing the chart. But I don't always. I can just eyeball a wedge and just see where roughly the measured target is. Same thing with fibs, Fibonacci ratios or extension or the ratios. So here's there's the 38.2 fib is right there, about 210. Where was my first target? I hadn't done this yet. There it is. So my first target's about 208, and that would be a typical pullback to the 38.2 fib. Here, we can put them all up on this board and see if they overlap. Again, I haven't done this in advance. I'm just doing it now, and Fibs are part of my trading. I usually put them on after the fact, and I do that because some traders trade exclusively off fibs. I like to incorporate them into my trading because if it's just a counter trend pullback, you're typically going to drop anywhere from the 38.50 down to the 61.8 fib, this range here. And you can see there's my first, second, third target for NVIDIA. Now, for kicks and giggles here, let's just assume that I'm going to be right. We're going to hit my third target zone I gave you on NVIDIA here on this wedge break. That would be a drop of the highs, a correction on NVIDIA of 20%, 21%. It's down to about 22% to the bottom of the T3 zone. NVIDIA, again, is the largest component, the largest stock in the world, the largest component, highest weighting in the NASDAQ 100, S&P 500. The odds of the stock market going up with NVIDIA dropping 20% are next to zero. And again, that's mathematical weighting. Talk about the psychological impact, then boom, forget about it, because it's going to just kick all those AI trades in the nuts if NVIDIA were to drop down 20%. Let's move on. Now, it could go the other way. You know, that's very possible. So I'm just showing you which way I think is likely. You got a little bit of a bear flag type action going too since the breakdown too. We'll see if it plays out. Again, earnings is kind of a wild card. Yes, as I told you, my two cents on, you know, which way it's likely to go. But earnings can foil even the best laid out bullish or bearish setup. But with that being said, I play odds. Like I say, in stock market and investing and trading, there are no certainties. I don't deal in certainties because I meant to say in possibilities. Anything is possible. I deal in probabilities. So what I'm going to do is put a little line here. I notice a jog around that previous high right there. So that's a little support level as well to break. All right, let's move on. You guys know my thoughts. Oh, and where I was, I got off on my little tangent here. There's three components to earnings report. I always say this. This is just from my years of experience. 1, 2, 3. And so the three components are this. There is the initial earnings release. That comes out. The company releases a statement. It's got a couple paragraphs of text, the numbers, the numbers for the quarterly earnings. And both man and machine parse through that data. That's where the bobbleheads will come on CNBC, tell you their 2 cents, bring in their experts. But at the same very time it's released, hedge funds and pension funds and big institutional traders have algo programs. They're going to rip through that like ChatGPT and Perplexity, and they're going to read through it, parse through it in a second, tied into their trading algos. So you're going to see that volatility. The stocks either usually shoots up, down, and in very few instances have I ever seen an initial leg up or down, knee-jerk reaction up or down that wasn't followed by one in the other direction. It does happen, but usually you see a lot of big rips and dips. Again, I read it's just like the movie Less Than Zero. I put a less than zero weighting into that. It's just noise. So I'm trying to tell you, don't act on it. That's also a reason why I've shared my strategy that I've kind of developed over the years, and I reiterate all the time with you guys about on trades. If I happen to take a trade, a position in earnings, or I have a related trade, let's say the NQ futures, for example. They're highly correlated to NVIDIA. I will always have my profit-taking orders with the checkbox. They're good to cancel on a swing trade. I have an order at my profit target, and that one's allowed to be filled outside the regular trading session, whereas my stop-loss orders are not. And what that does, and you'll see with NVIDIA and you'll see with QQQ after they report, that noise, if this is a chart, this is just a 1-minute chart, up and down, my goal in any trade is to not be stopped out, but to hit my price target. So I want to take advantage of that post after hour session, what I call noise, and very often it does. It'll clip, run up, hit resistance level, which is my price target on a long trade, or support level on a short, close me out, then reverse. Whereas then I don't want that to happen on my stop loss order. So that's it. So my OCO orders, one cancels another, has my profit taking order, my stop loss order, only the profit-taking orders allowed to be filled in the outside the regular trading session. That means pre or post market. On futures, it means around the clock, really. It could be 3 in the morning. All right, so that's number one. Kind of don't read too much into it as a bottom line. Again, sometimes a big earnings blowout or miss or negative. And that's the second part. Let me get to that. Then comes, okay, so that's the earnings release. There's the data. CNBC will be parsing through it, getting everybody's 2 cents on what it means, all the different parts of the earnings report. Then comes the conference call. And I can't tell you, again, part of what I do here, I'm trying to just share decades of experience. I can't tell you how many blowout quarters I've seen with a stock explode higher in the after hours or reverse, and usually at the end of a downtrend. Typically, this happens followed by the big reversal after a downtrend like this, when a stock's been in a bear market, been in a downtrend, because stocks typically bottom on absolute horrible news. You know what the saying in the stock market is, it's always darkest just before the dawn. Think 2000, March of 09, when with financial crisis, that was at the throes of it, at the bottom. Everybody thought the world was going to come to an end. And then boom, it was over. March 6, 2009, if I remember right. And of course, it was a big plunge down that day, followed by a reversal. Same thing when COVID hit. So it happens in reverse. You tend to see, if a stock, and I don't know whether NVDA tops, if it already topped, if it tops 2 years from now, or if it tops in a month from now. But typically, that's one thing I've seen after just a big run up, excessive bullishness, you get a big pop followed by a big reversal. And again, that can be triggered by the conference call, because if they blow away all the numbers, which they almost always do, when you're in the $4 trillion club, even in the $1 trillion club, you're playing the game at the highest level. And these companies, Alphabet, Apple, Meta, they manage earnings, they manage expectations, so they almost always beat their numbers. So that's not a big deal, big surprise. They usually beat them because that's how they manage it, that's how they play the game. But the conference call gives guidance, and if just one little thing is sniffed out, they don't like margin compression, any other statements, that can send the stock the other ways. And then the final component, let me just move on, is the next day. NVIDIA, like most tech companies, reports after the market close. In the after-hour session, there's a lot of trading on NVIDIA. There will be tonight. But typically the biggest players, the big institutional funds, pension funds, big hedge funds, they have so many shares. It's not a very liquid market. It's not as easy to trade. So I always say the third and final component to an earnings report is how the stock trades the following day, the first full trading session. Sometimes it takes 2 or 3 trading sessions before a stock that has a blowout quarter peaks. Apple's notorious for it. I mean, if you go back, I just, over the years, noticed so many tops come on Apple. Let me see if my marker's on this chart. Yes, quite a few. And I have to go back for years. There's an earnings report there. In the last couple of years, I haven't seen some, but there's been many companies that peak right on or around blowout quarter. Apple, every time they report, and all these companies, it's the best quarter ever, highest earnings. Of course, over time, especially with the inflationary effects of the dollar, which puts the dollar down, earnings are going to go up. These companies have share buybacks. A dollar is worth less in real terms than it was the previous quarter and the quarter before that with this high inflation. So, that's no surprise. You expect the earnings to grow over time. Again, it's going to be that forward guidance. So, all right, enough on that. I just wanted to talk a lot of it because I didn't talk about it yesterday, and kind of took my eye off the ball with the QQQ bounce targets. But still, we're very much below where we shorted it here. And again, that trade's completed on the 5-minute chart. That's all that was, but I still have targets for you on the 60 that are very, very much still in play. And then if these get there, I'm going to put a level right here that is now a significant support level, because we've had, it's actually 3 reasons I did that. We have a gap right here That's the bottom of that gap, a reaction low, and another reaction low yesterday. Give or take around 696, right? So if we break that, you're going to have all the makings of a near-term downtrend in QQQ on top of a longer-term or intermediate-term uptrend. A downtrend is simply defined as a security making lower highs and lower lows. So if that's taken out, then we'll have that. And you'll probably see, and then we'll hit most likely T1, and it's going to increase the odds of my other targets being hit, at which point I'll turn my focus back to the more significant daily charts. Okay, let's move on. We'll get away from the markets. I'll talk just to reiterate on XSD and SOXX still below the levels. And then I've been talking about the VIX lately. You'd have to go back. I'm not going to get into the weeds here. This video will go too long, but I did cover in recent videos the pattern, the fact that the VIX, with the stock market fresh off all-time highs, the VIX has not made a new low and hasn't even come back to the bottom of its trading range. You have this level here is really good support, and then this is the extreme low. You can roll back farther. So this is really, other than this one period of extreme low, that's big support. But I showed you the pattern where right before the bear market, there was a bear market that began right and around the beginning of 2022. The first real bear market was about a 38% drop, I think, in the NASDAQ and or S&P. I think the NASDAQ. And the VIX did the same thing. It bottomed, but it made a much higher low at that point, right when the stock market was making new fresh all-time highs. And then, so like I said, and the technical posture was there. We're just coming off that bullish falling wedge breakout. So this kind of plays into the fact that post NVIDIA or whatever other factors may be, that the VIX is about to, it could be poised for another rip. And there was a last bullish falling wedge breakout. We had a long on the VIX there. We had a long on the VIX there. Popped up 100% gain from our September 12th entry. And, it took a little while. Broke out, put in a divergent low. And then just one day woke up. And then did it again. It woke up again. And we pointed out that divergent low, and it woke up one more time. And it's, again, a similar technical posture. It doesn't guarantee that it must do that. It just, if it does, again, the takeaway, I would wait and see what NVIDIA does. Because if NVIDIA doesn't break down, especially if NVIDIA gains, in the days to weeks after earnings, it's going to hold the market up with it. And it's not going to, the VIX isn't going to do much. Given the VIX, has what we need to see is really the financials break. I've already covered that in recent videos. The VIX is based on the S&P put and call buying. There are no financials in the NASDAQ 100. So, however, it's the same leading tech is still the biggest sector in the S&P, but financials are number 2. So you need to see the financials crack to see the VIX get going. And so I'm very much watching those. I've covered that recently. I think 51 is the support level I want to see clearly taken out on XLF. All right, let's just talk the rest of it now. For those of you that may be short, whether you're short or not, these are pure plays or indirect hedges. So yesterday's video, I think it was, I talked about how I could guarantee you it was all hands on deck at both Treasury and the Fed to foil the multi-year breakout. It shows better on TYX. TYX is a yield of the 30-year Treasury bond. Oops, there's all my lines populating. I was going to add another one. Let me delete that. Let me go to a clean board here, and I'll just show you a nice and quick recap. So what I'm putting that line at, we've had 2 equal highs in the last few years. This was in 2023 right here, about October of 23. And then we hit that yield on June of 2025. And as I've been stating all along, I expected a breakout to new highs. Ultimately, we got it, but it was also, a slight punch through there. Remember, that was a new record high yield that wasn't just, short-term thinkers, those playing chess or checkers instead of chess see a 52-week or new, recent high breakout. But as I mentioned, that took yields back to levels not seen since, to take the line across, when we broke those 2 highs, we've taken yields back to where we were just before the financial crisis. That was late 07 to early 09 right here. financial crisis, and then the dot-com bubble burst. That bear market went from March of 2000 into mid 2002, and that's where it took yields back to. So again, it's a it's a number, and it's a level that I think is still going to be clearly taken out. But as I said, everybody's aware of it. Anybody that deals in the bond market and even in the stock market, and certainly the folks working at the Department of Treasury and the Fed, they're very aware. So I said they would come in with whatever weapons they have, whatever tools they have to try to foil that. All I can tell you is right now was a failed breakout because we snapped back up in there. And like I said, Treasuries can be a indirect hedge, because if yields keep going up, Treasuries are going to fall. So if you're long Treasuries, you're going to lose on a Treasury short, but that's going to, again, I would eat my shoe if it doesn't affect the stock market. If we hold a breakout, again, if, not just a little punch through one day and a pullback, but a sustained breakout and rally. Even in the 10-year, you've seen the 10-year coming up. That's the one that the markets really watch closely. 30-year matters, don't get me wrong. We have a lot of debt, to service. They've been issuing more on the shorter end of the curve lately to try to, because the Fed and their, short-term thinking, or Treasury. It's Treasury the one that decides, what to issue, what terms. But you can see the 10-year is creeping up as well, and it's also threatening. It has to take out that high from 2003. But either way, this is what drives 30-year mortgages and all that other good stuff. So there's TNX. Watch it. Like I said, if you're short the equity markets, you don't have to be hedged now, in my opinion, because we already had the sell signals I was waiting for on Friday. But it's a indirect hedge. It can be a pure play. Pure play meaning maybe you don't want to short the markets. Maybe you don't want anything to do with the stock market, but you have positive divergence right here on the 60-minute chart, and you still have some potential targets. So there's that one. And then USO, or crude oil futures, like I said, remember, the futures look a little different. USO does as good a job as any ETN can. Remember, when it comes to the world of commodities, whether they're agricultural commodities like wheat, corn, soybeans, or energy commodities like natural gas, crude oil, they have these, they're usually ETNs, sometimes ETFs, but usually ETNs that track using the futures. So they do as good a job as they can, but they have a lot of expenses, fees. They have to roll the futures contracts. They have to do it, and they can't do it like you and I. If we're trading futures, I roll mine on a single day. If I have 1 or 10 contracts and I decide it's time to roll, I'm going to close out and buy it. It's a one single transaction, one commission fee. They have so many they have to roll periodically. It generates additional fees, commissions. So they're not going to track perfectly, is what I'm trying to say. But either way, we've gotten up here, and each time I mentioned, is either a pure play short. We had some of the targets on that drop there. Did again here, and we're back to that high end of the range. And then we had a sell signal today. Remember, just getting to resistance or a high end of a range is not a sell signal. It could be an objective short entry if it's good resistance. But today we had a sell signal, so that's it. Now, here's the thing. Falling crude prices are net bullish for the stock market. But as I also talked about before, what I think the stock market is missing, and this is just my 2 cents, right or wrong, is that I've talked about this repeatedly, that it's a function of when I gave you those zones way back here a couple years ago. I know this chart's really busy now. I wish I could clean it up. I have a lot of lines, but I gave you 3 zones. I'm going to color them in here. That's the yellow zone. I gave you an orange zone and a red zone. And every time we hit that red zone, the stock market corrected. The zones were there because I was very cognizant that oil doesn't matter when it's down below 80 a barrel. It doesn't matter if it's 50, 60, or $70 a barrel. The world keeps spinning, and that's it. Gas is fluctuating a little bit, the pump. But when it hits, there's a threshold. Again, and I've noticed that threshold, and I've talked about it on the crude long-term future chart. It was when you hit 78 from below. And on USO, I had the red zone here about 83. And all the way back then, I said it's a function. And every time we got there, the market had a nice correction. This time we blew above it. And I said it's not just, and I still maintain this thought, that it's not just the absolute level of crude prices, but it's how long they remain elevated. Because the stock market, you or I, think of you as a consumer. Let's say you're one of those poor folks that has to commute, 2 hours every day. I know those people are out there, and oh boy, I feel for you. But let's just say that's what you do, and you don't have a Prius or whatever. You've got a regular car that drinks some gas doing it. Yeah, you're feeling the pain. Now you can handle $4 or $5 gas for a couple of weeks. It's not going to kill you. You're not going to like it, but it's not going to kill you. But as time goes on, and now take that thought and expand it out into the entire economy. We've been elevated for a while. So even an abatement right now, even to back down here, you're still going to have relatively high, I'm talking relative to the high end of, historical high end of gas prices. And we've already been there so long. There's a lag in inflation. There's also gross underreporting, in my opinion, from on the CPI and PPO, but producer price index, PPI. But either way, that's what I'm trying to say. So near term, look, the market could rally or not. They may start to realize that, hey, we keep getting these little pullbacks, but we keep going higher until crude comes back down to below 85, 90 a barrel and stays there. The damage may be done to the economy. That's my strong take. I use that analogy of a hunter that misses the kill shot on a deer. I'm sorry to be graphic, but you guys know, if that's a thing, shoot it in the heart, it's going to drop, and it's quick death. But a lot of hunters aren't that great a shot, and they get excited and they just fire it off, and they gut shoot the deer or whatever, and the poor thing's going to run off, but it's ultimately going to die. It's going to bleed out. They just follow the blood trail. That's what I think is happening to the economy right now with these elevated prices. But you've got this tech mania right now going, and as you know, the stock market and the economy, they're not one and the same, and consumer sentiment is what drives stock prices. And that's the same reason at the end of a bear market, prices, valuations are dirt cheap because the pendulum has swung too far in the opposite direction. So either way, guys, this is the bottom line. You can pure play short it. I gave you a lot of what I call micro levels. I think at minimum another pullback to this area right here based on this bearish rising wedge breakdown. Wouldn't be surprised to see us go down here. All I can tell you is when you short crude at this high end of the recent range, if you're doing it as an indirect hedge to the stock market, and again, you need to adjust that down. You only need about a third, maybe 30% or 35% short on crude to offset a 100% 3 times short on the stock market. Because if crude continues higher, I see absolutely no other likely scenario other than stocks down, other than that's going to be talked about, and it's going to put pressure on the stock market due to the rising energy costs. This, a little abatement, we're still elevated as I just showed you, but obviously it's incremental. With each tick lower, you cannot argue that that's not incrementally more bullish for the overall stock market and economy, right? But there is a scenario where crude prices could really tank or start a downtrend that continues on and gets us back down below 90 a barrel, but that could be bearish if it's due to demand destruction. But that's going to take, I think the only thing that's going to happen, in my opinion, would be a significant correction and or we enter a bear market in the stock market. And at that point, falling crude prices, it's too late because the damage is done. You've now broken a trend. If the long-term trend indicators on the stock market flip to bearish, you go back down below the 200-day moving average, it's a vicious cycle. This has been very well documented. The wealth effect right now is a vicious cycle that's keeping consumer spending, especially on the high-end and mid-end consumer, going because their 401ks are up. This tech bubble is lifting all stocks, or the indexes at least, I should say, not all stocks. I need to be clear on that because, as I've told you recently, the majority of stocks in the NASDAQ composite are below their 200-day moving averages. So there's, under the hood, if you lift it up, a bear market on most stocks, or at least not in a bull market if you want to get technical. But the overweighting of the big Mag 8s are giving that false guise of strength to the indexes. due to the fact that they're, doing all the heavy lifting. Okay, so that's it. So either way, pure play it. And I'll continue to give updates. I kind of threw it out there as a more official trade today with some targets, but every time we get up here, I keep mentioning you can use that as an indirect hedge. But now this is a clear, like I said, this is before it's just a relative thing getting up high. And if you are short the equity markets, at this point in time, we have an actual sell signal right there. Nice, clean, well-defined uptrend line / wedge break, big negative divergence that's been building, and so that's it. So either take it, don't take it, up to you. I already covered TLT. Now let's just update a few stocks. I view these also as indirect hedges on the market. Okay, so a few months back, I highlighted the software stocks, and I was using a different software. What was it? One of the S&P. It was this guy here, XSW. And then somebody brought to my attention, I like this IVG. And then, really like that, and clearly stated in the video when I covered it that my expectation, if the stock market and the NASDAQ 100 and the S&P broke above and held above their 200 days in the trading ranges, you would outperform that the software stocks would outperform the broad market. And they did. They went up, hit that 94.43 target almost to the button just yesterday, talking about a 27% rally versus, we won't go with the S&P. That was, hold on, got to go to the bottom there. That divergent low was on at support April 10th from that point. Even if you go with the tech-heavy QQQ, which keep in mind has a lot of software stocks in there. They're mostly listed in the NASDAQ. April 10th is this candle right here. You have a comparable gain of over the same period of time, a gain of only 18%. So nearly a double outperformance. And again, this is security selection, just sniffing out the things with the best-looking charts. And, looking for relative outperformance. Look where it got rejected. See that red line there? 200-day exponential moving average. Nice price resistance. And here's the chart I gave you on April 10th right here. They're always time and date stamped. After the 16% rally off the initial drop to the 1776 support, so that's where I first mentioned them. That was when I was using XXV. Got bullish there on the on software, saying it was overdone with positive divergence. IGV has extended the divergence and fallen to the 7750-ish support, which providing one of the better looking long setups should the stock market remain above the 200-day moving averages and make another run to previous all-time highs. So that was it. So and it very much did that. But again, now I'm a little hesitant. It's pretty big resistance, run full circle. I'm giving you a couple software stocks recently. Now that doesn't mean just because that's resistance we can't continue higher, and it doesn't mean we can't continue to outperform. So if we can break that resistance, get above the yesterday's highs, break the 200s, your next stop or next resistance level, you have the 200 simple moving average in blue right above it. Let me move that. And comes in with that 99.29 price resistance. So the software stocks could carry higher, but the bottom line, guys, if you took it, I think we sheared most of the meat off the bone, especially on the initial run up. We're getting overbought. We're starting to see some divergence, potential high-level bearish PPO crossover. So what I'm doing, I'm throwing caution to the wind, and I'm also doing what I always do. I'm going to share trade ideas, long and short, in various stocks, sectors, indexes, various commodities, different asset classes, whether I take them or not. My job is not to take your trades for you or tell you what to buy or sell. It's to share trade ideas. So if you like what I'm sharing, and I'll also tell you how they can be indirect hedges, because if the stock market, if I'm wrong, and the sell signals we got on Friday on the semis and QQQ don't play out, and they're just a little quick pullback, and we get bought up and ripped to new highs and beyond, then these long trades I'm sharing with you, especially in the tech sector, I believe will continue to outperform. And I'll roll into some of those here right now. But just on that too, I also gave you on April 10th, the same day I think we bottomed, that it wasn't just price support. I made a case also on this weekly chart. This was off the '09. This is the secular bear market low. There's the financial crisis. Tech, most folks don't know it. The official bear market bottom was March 6, 2009, because all the indexes but the tech heavy NASDAQ bottomed in March of '09. The NASDAQ bottomed in November, and most tech companies did in November of '08. And that's when this trend line comes. And then you catch that '09 low right there as well. Just super well defined. Price support, intersecting support. So that was the bounce. And again, to me, it was just a bear market rally. This was a divergent high. This tells me the software SOXX probably peaked. And God forbid they take out this primary, again, secular bull market uptrend line. These are cyclical bear markets right here within a longer secular bull market. When that secular bull market trend line goes, it's probably going to take the software stocks a whole lot lower. But right now we're above it. That's what I gave you on April 10th. And here's the weekly now. Boom. Bounced off it. Again, is it the last hurrah or the best buying opportunity in years, as if you believe that the software stocks are going to go to new all-time highs and continue their bull market? I'll leave that up to you. I've shared my thoughts, and more importantly, you have some individual trade ideas on there. I gave you FIG recently. Thank you. One of the subscribers brought it up to me, asked my 2 cents. I liked it, gave it to as a trade idea, and I'm going to highlight it right now. The buy signal was to come on a break above 2150, even though we had already broken out, back tested the trend line. So let's give it the benefit of the doubt. So we gapped up, right up. It was an objective entry in 2150. We started going up and we pulled back to it. Resistance once broken becomes support. So what I'm telling you right now is this one is offering an objective long entry. Now, with NVDA reporting tonight, do you want to buy today? That's up to you. If the market likes what they're selling, then this stock will probably go up. And if the stock market continues to rally, especially if it takes out the recent highs, I think FIG will hit at least my first target. Your profit potential on this, if I'm correct, we go to my first target zones, 42% to the bottom, 55% to the top of that first target zone, and as much as 91% if my second target's hit. However, again, the stock market's going to make or break this. There's a gap right there. So if we drop down, I'm going to give you another level, which would be an objective buy point down to, but not below, for a gap backfill. If it wants to backfill the gap, 2033. Personally, I would not add below 2033. Yes, technically a back test of the trend line is an objective entry, but you're going to have to take some pain if you're going to ride out a back test of the trend line, because there's no way to know when you get there. And then sometimes you can continue to ride the trend line down for a while before you reverse. So that's still the max stop on the trade. That's calculated to the if you're holding out for the T2 level. But again, your stop will be commensurate with your average entry price and your preferred price target and your preferred risk reward ratio, your loss tolerance. Everybody's different. Some people can't tolerate 2-to-1 or 3-to-1 RR. Some like a tighter RR. All right, so the other ones I have for you, I gave you BYND, a trade update today. Again, called it a gunslinger trade when we popped it back here. We bought it in the pre-market session there, and I gave you 2 price targets. That was right there. Yeah, so those should be moved over a little. That was a quick trade. Again, you don't see the entries because a lot of the entries I get to and exits are in the pre and post market session. So you can reference the chart. I'll give you a link to that trade. And now we've come full circle again. We have a nice downtrend line in which to trigger a buy signal. So we pop that. All the better if we get above 82. It's become somewhat of a meme stock. The Reddit group loves these little penny stocks, and if they start picking it up on the Reddit boards and all that stuff, they can pop it up there. But anytime you're dealing with a penny stock, anything under $1, the risks are high, including but not limited to a sudden bankruptcy filing. So I don't know the first thing about the fundamentals. I can just tell you there's problems with this company if it's fallen this much. And that's it. So like I said, if it's not your cup of tea, pass. Don't take this one. But that's we bought it here. We hit the second target in the pre-market session. I posted a chart at the time showing you we were actually a little bit above it. Take profit there. It was objective to here in the first pullback. And if you took that first pullback to 82, which I highlighted, it was in today's post, it bounced back to T1, made a quick 36%. Still resistance, pulled back from there. Now we need to break that trend line. And like I said, anything much above here, I would not be adding. I would be more concerned about stopping out. With a stock like this, don't be surprised if you wake up to a sudden bankruptcy filing and the stock's 30 cents. So what I tell you is, Vegas money, or pass on it if you're not an aggressive trader. But Vegas money means you don't have to put a lot in to a stock that has the potential, in my opinion, to make 200%. We've taken this stock for 100+% runs several times at least over the years. It's just the nature of this beast. I know it. I know this, but now it's getting down to penny stockville. You face a delisting if you trade under $1 a share for too long. So there's a lot not to like about it. So I'm trying to do my best to scare those off that only see the dollar signs, because I kind of sometimes see this on the website, especially with leverage ETFs, things like that. Either way, if I didn't like it, I wouldn't pass it along. And again, it's one of many trades. Diversify. Don't put all your eggs in one basket, and don't take a big position in a penny stock. That's just financial suicide. Okay, Grab. I gave you Grab today. We had Grab before as a recent trade idea. Was entered, I think, in the pre-market session. Yeah, we had a quick one-day pop of 9. And it's a new trade now, so that's why I kind of de-highlighted. There was the stop. There was the 2 price targets. We had that first one. And there it is. It's got pretty decent support right here. Price support, major reaction low there. So you can either buy it on or just off this support. Or, like I said, my preference, if you wait till NVIDIA's out of the way and you wait for a breakout above the trend line, I need to tighten it up a little, nice and tight. We're very close. Then that's it. Your first target, TL means trend line, so go up there. I can't tell you exactly where that's going to come in, because if we do break out, because trend lines are dynamic, meaning that every day they come in a different price level. Probably be a pretty quick move up. 9%, 9%, T2, T3. And also, it is a software stock, so I just spoke quite a bit about that. So again, now this is another indirect hedge. Let's say you are short the semis or QQQ or the NASDAQ futures, and you take some of these like FIG and Grab. Well, if the NASDAQ keeps going up, and these are some of the bottoming plays, these are some of the software, well, they did, don't get me wrong, they did, and we caught it. They participated in that first pop, and we caught it too back then in the software stocks, and then I re-highlighted them again. But these are a few laggards here, and they're just setting up nice. That's all. I can't say anything more than that. They look poised for another, at least just a bear. I'm only looking for a bear market rally in them. If we hit T3, you might think, oh, Randy, that's an aggressive target. You're calling for a 27%, 28% rally. All it would be is a bear market rally back to the 200-day exponential moving average and price resistance. And that's what swing trading is. Get in, get out. Or, hey, maybe we get there and I like it. Maybe the stock market's done something to convince me, in the bond market and crude oil and the Fed, God forbid, that says we're going to have a blow off top in the stock market. Then I may extend targets. Sometimes I do that. Sometimes I add price targets as the trade gets going. Before we get to the final target, I'll extend price targets. And sometimes I'll truncate a target if something doesn't smell right. So we get to T2 and I say, hey, I'm closing out T3, making this the final target, get our quick, whatever it is, 15%, take the money and run kind of thing. All right, I'm going to wrap it up here. Long enough video. And as I've told you recently, if and when I get the time, it's a little bit of a pain right now to generate a transcript. I got to go there sometimes, clean it up. The initial transcripts from YouTube are messy. Cut and paste it, and then run it through an AI engine, either Perplexity or Gemini, or the two I usually use. And then I'm posting. It can take up to an hour or more. But if you go back, if you're not in a rush, and I post a video like this, I'll do my best to post those AI-generated transcripts. I think I've gotten a lot of positive feedback on it, and I like them too. You can see right there And I tell it to include the timestamps so you can see what I'm talking about and exactly when in the video I'm talking about it, so you can skip ahead. If you have no interest in penny stocks, you could have skipped Beyond Trade, or if you heard me say the same thing over and over about the Texan Semi, you could have skipped that part of it in the beginning of the video. All right, let me wrap it up here. Let's see what NVIDIA in the market does tonight, and then I'll give you my thoughts. Either tonight, I usually don't comment right after earnings. I just watch the clown show, the post earnings volatility. If something huge happens, I'll get a post out to you. Otherwise, we'll follow up tomorrow. And just a reminder, I'm leaving town tomorrow. I don't know if I'll be here up until the close, but it's a 3-day weekend coming up. I'm going to go over visit family in Miami. So I will be cutting out possibly early tomorrow, but at least here through the first half of the day tomorrow. And then we'll pick things back up on Monday when I'm back in town. Or no, Monday, I'm sorry. Monday's a holiday. Tuesday, you can pick it up. This has been Randy Finney with Right Side of the Chart. Have a great day.